We're talking about SMX, a stock that, many people had completely written off. And then suddenly, boom, an explosive 26% gain in a single session. It just smashed right past that critical $20 mark, and now every single volatility trader is watching it. So our source for this is a really sharp strategic analysis report that tries to answer the big high-stakes question you're probably asking yourself right now. Is this a classic dead cat bounce, a dangerous trap for buyers?
Yeah.
Or is this the real deal, the start of a massive short squeeze, maybe even a 100% runner back towards 50 bucks?
And that really sets up our mission here, doesn't it? This analysis pinpoints 3 very specific catalysts that lit the fuse on this thing. So our job is to walk you through those, weigh the very compelling bull case against the very serious, very real bear case, and arm you with the data you need to see the risk and reward here. We're looking for what separates a real breakout from just another trap.
Right. Let's start the beginning then. The ignition. Why did this happen now? I mean, if you just looked at a chart, it seems like total chaos, but the analysis is clear. This was not random.
Not at all.
It was based on 3 key pieces of news that all dropped right around the new year. And they seem to have, fundamentally changed the short-term story for the company.
That's exactly it. For months, this stock was just getting crushed because it was seen as a concept company. A great idea, maybe, but with a serious cash burn problem. These announcements shift that narrative from just a concept to, concrete applications. And for the big money players, that changes everything.
Okay, so the first one, which the report calls the rubber revolution, dropped on New Year's Eve. SMX announced they're expanding their tracking tech into the global rubber and latex glove market.
And the really significant part here is the scale. We're not talking about, tracking sneakers for consumer. The report really emphasizes this. This is about solving a massive, multi-billion-dollar industrial waste and authenticity problem for huge global companies. When SMX gets these kinds of B2B verification contracts, they're often very high margin, and they're sticky. It's a real solution to a supply chain nightmare, not just some neat tech.
So we're moving from a theoretical idea to solving a very expensive, very real pain point for industrial giants. And this came just days after another big announcement, right?
But tracking gold, from the mine all the way to the market.
So you start stacking these things up, denim, gold, and now industrial rubber. All of a sudden, you're talking about contracts tied to these enormous global supply chains.
Precisely. And those contracts, they form the fundamental basis for the bull argument. But the third catalyst is probably the most important one for explaining that initial 26% jump, because it tackled the biggest fear head on.
And you're talking about the $111.5 million equity facility they secured? I think most people hear $100 million and just think, great, problem solved, they've got cash.
Right.
But you're saying it's not that simple. This fix has its own pretty big side effects.
Oh, absolutely. I mean, look. For months, the number one thing killing this stock was the fear of bankruptcy. Simple as that. This facility acts as a funding safety net. It removes that immediate pressure to find cash or just, fold up shop. And that relief, that alone, was enough to justify a huge relief rally.
But the analysis points out this is a double-edged sword. It provides stability now, but it also creates this serious risk of dilution later on, correct?
It does. It's a trade-off. Stability now for a cap on the upside later. This thing is structured so the company can sell shares directly into the market over time to raise money. So while the company is safer from bankruptcy, that potential supply of new shares just hangs over the stock like a ceiling, ready to cap any rally that gets a little too hot.
So, okay, the good news, the contracts gave them a reason to survive, and the funding gave them the oxygen to do it. But what turns survival into a potential rocket ship?
And that brings us right to the bull case. This is where the mechanics of the market get, kind of bizarre and really compelling. The analysis argues that a 100% rally is possible almost entirely because of the stock's current structure.
You mean what the research calls the ultra-low float dynamic. Can you break that down for us? What is the float, and how does a reverse split create this kind of situation?
Sure. So think of the float as just the number of shares that are actually available for trading on the open market. It's the public supply. This company has done several reverse splits, which basically just shrinks the total number of shares out there. A lot. The result is an extremely small pool of available stock. So when the float is ultra low, the supply is tiny. And any sudden increase in demand has this just massive outsized effect on the price.
And we saw that exact leverage today. I mean, the stock jumped 26% on only 700,000 shares of volume. For a big blue chip stock, 700K volume it's nothing. It's a rounding error.
Exactly. It just shows you there is no supply available to meet even a little bit of speculative demand. The analysis describes this low float as a tightly coiled spring.
And this is where the risk-reward ratio just goes into overdrive. The analysis projects that if this move gets some buzz and volume picks up to, say, 5 or 10 million shares.
Which is still not a huge amount.
Right. But with this float, the sheer lack of liquidity could send the stock flying right past $30. maybe even overshoot it violently.
And that low float mechanism is the fuel for the second part of the bull case, the squeeze setup. Short sellers, people betting the stock will fail, have been piling on for months. They were confident it was going to zero because of the cash burn. Now, the analysis shows that if the bulls can just hold this price above that key $20 level, well, those shorts who were so comfortable might suddenly be forced to buy shares just to get out of their losing positions.
And when you get forced slamming into an ultra-low float environment, that's when a rally can turn chaotic. And that's how you get those 100% returns the bulls are looking for.
It is a textbook setup. You have very low supply meeting sudden panic demand. The only thing the bulls need now is to connect this whole technical setup back to the new fundamentals. The contracts for denim, gold, and rubber are the foundation. The next logical step, the thing that would really validate this whole move, is an announcement of a major revenue-generating partner. That would back the hype with real cash flow.
That's an incredibly compelling picture. It really is. But the history of this company is just great. It's littered with failed rallies. So we have to pivot and talk about the dead cat warning. The history here demands caution. I mean, I'm looking at it. Multiple reverse splits, chronic dilution. Why should anyone believe that this time is different? That management won't just crush this rally to raise more money?
That is the exact skepticism you have to apply here. The number one warning sign in the analysis is the company's long history of acting as a dilution machine. They have funded their operations again and again by just, printing new shares.
So that new $111.5 million facility, which solved the immediate crisis, is also this giant looming cloud of potential new shares just waiting to hit the market.
Precisely. It's what's called an at-the-market facility, or an ATM. This means management can literally decide to sell shares directly into any strong rally whenever they want. They can use the rising price to generate capital.
So for the bears, this is like a built-in defense mechanism. It basically ensures that every time the stock tries to make a sustained run, there's an official sell button ready to cap the gains.
Right. That ATM facility is an institutional financial ceiling. It makes a sustained, multi-month run incredibly difficult to achieve, even if the initial spike is real.
And then there's the long-term technical trend.
Yes. Despite this huge pop today, the bigger picture trend is still bearish. The analysis is very clear on the criteria for a dead cat bounce. It says that until there's a sustained high-volume break above the, say, $25 to $30 range, this move is technically just a temporary bounce in a much larger downtrend.
Yeah.
It has to prove the old trend is broken, and it hasn't done that yet.
And underlying all the market mechanics, all the technicals, is the cold, hard truth of the cash burn. The report makes it clear they are still spending money very, very quickly.
The new contracts are a phenomenal start, but they don't solve the immediate cash flow problem overnight. The company's in a race against time. Those deals for rubber and gold have to translate into actual significant revenue and fast. Otherwise, the temptation to just use that $111.5 million ATM will become overwhelming, and the only option will be more dilution.
So we've laid out both sides, the incredible leverage of the low float on one side and the serious entrenched threat of dilution and history on the other. What does this all mean for someone analyzing this move right now? Where is the battleground?
The analysis boils it all down to two critical price levels. These are basically the lines in the sand that you need to watch to see if the bulls or the bears are winning control. First is the bull trigger. This is what signals a momentum breakout. You need to watch $23.25. That was today's high. If the stock can break that level and do it with real volume, it signals that the initial rally is turning into aggressive buying. A sustained break there, the analysis suggests, opens a clear path to $28 and maybe even a quick run toward $35.
Okay, so that's the upside trigger. What about failure? Where does the dead cat bounce theory win?
The report identifies $17 as the critical stop loss level. That's the point of momentum failure. If the price falls back below $17, it's a huge red flag. It means the low float magic is gone, the momentum has died, and the shorts are back in control. The whole move would then just be a failed bounce, proving the bears right.
So the final assessment is that this is a true knife-edge situation. A high-risk, high-reward play where the news about the new contracts is real, but the history of cash burn and the danger of dilution make it extremely dangerous without, very tight risk management.
Exactly. The market is pricing in hope, but the company's history is pricing in failure.
So we've really unpacked the core tension here, a genuine strategic shift towards real contracts in huge markets, but it's fighting against this deep-seated bearish trend and the constant threat of new share issuance.
And that tension leaves us with one final provocative thought that comes directly from the source material's concerns. Given the urgent need for cash and the company's historic reliance on raising it, which factor do you think will have more influence over the next quarter? Would it be the necessity of turning these new contracts into immediate visible revenue? Or will it be the temptation to just use that $111.5 million equity facility to quickly raise cash, which would almost certainly cap any rally before it really gets going?
Yeah.
The long-term future of this stock really depends on which of those two pressures management decides to prioritize.
That is the million-dollar question at the heart of this whole thing. Thank you for sharing these sources with us and